Hi, it's Aoife and Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, December 18th. We're recording this in the morning in the UK. It is our last recording before the Christmas season, and we will return to you on the 26th of December, next Friday, to discuss everything that's passed over the last week. In this podcast, we're going to be reflecting upon whether markets are feeling as joyful as a season of joy would suggest, or whether there's a touch of humbug. So as usual, let's share the slides. I've called this podcast a festive countdown, as we are indeed in a festive countdown. It has been a tumultuous month of December, however, some tragic news in terms of global shooting events last week. And we also came off the back of a November that was fairly tumultuous in terms of market performance, even though the markets did end the month fairly flat to slightly positive. There was a dramatic change in sentiment around the expectations for AI. This did come back somewhat, but I'd say it's safe to say that the seed has been sown for some skepticism around AI. And now when we look to the rest of the year, we can see that some profit taking is on many investors' minds, and perhaps a desire to diversify and broaden the market more. As usual, our topics will cycle through inflation, interest rates, equity markets, geopolitics, and other asset classes. We're going to look at Bitcoin's fourth annual loss, only its fourth since its own inception, but why this annual loss may not be as significant as some of the other annual losses. In terms of some of the sub-themes, we can see that inflation is coming into check and is displaying some good behavior relative to its history. Interest rates similarly seem to be complying with expectations, and certainly with what investors would like to see in terms of an accommodative interest rate environment. When it comes to equity markets, they have been positive, although just in recent days in the US, there has been some concern that, again, the AI story has been overblown, that perhaps all the risks have not been taken into account. And we look in particular at Meta and some of its missteps around business planning and expenditure that may suggest that there could be perhaps more trouble ahead. We will reflect on some of the rising geopolitical tensions that have emerged just this week. And then, of course, as always, look to portfolio implications as we near the end of the year. When it comes to inflation, this is a UK inflation chart, but I think it's interesting to show just how much UK inflation is now starting to finally mirror inflation patterns around the rest of the world. The inflation in the UK hovered closer to 4% than 3% for some time. It was around 3.8% for two consecutive readings, fell to 3.6%, 3.5%, and now it's coming in at 3.2%. So this seems to be a number that is giving comfort to the Bank of England to likely cut rates when it acts today, so 3.75%. And it is also a little bit closer to that US level, which is expected. The numbers there also expected today. They're expected to come in around 3.1%, according to consensus. So definitely not yet completely abated, but it is definitely more close to the target than we've seen before. 3% prices, remember, are still on top of a historically high rate of inflation. So we know that there will be pressure on the affordability theme. It's worth discussing here how the affordability theme has really got traction across the rest of the world now, not just the US. It started, I'd say, globally, but had really gained purchase in the US during the recent special elections, in particular the mayoral election in New York. We know that affordability has been a pressure point for consumers for some time, particularly at the lower right side of the K. So the lower end consumer that really is under pressure with basic non-discretionary items. And clearly this has become an election theme now, a calling cry for politicians across the US and increasingly across the world to focus on how they can get affordability back to the consumer. Whether this be through one-off incentives, we heard about a hero's dividend, a military dividend in the US, but there were also suggested that there would be tariff dividends. These would be short-term fixes, perhaps a short-term boost for expenditure needs, or whether it's going to come through tax breaks or through tax credits, or through simply working on the tariffs that had been in place. And that was one of President Trump's approaches in the past, to eliminate some of the tariffs that have been put in place. But there also has to be a focus on generally getting costs down, and perhaps in the long game of the current posturing around oil will be to get the price of oil down. But when we look finally at the inflation composition, we can see that it's the lion's share of inflation continues to be services. This is the global theme. Fuels and lubricants have occasionally been negative. Electricity and gas, not significant at the moment. Food also and other goods representing reasonable amount of inflation. So a lot still to work on there. Service prices being, of course, driven by price of labor. When it comes to interest rates, we've shown this chart a few times, just to note that we are reaching some form of a plateau. There has been the rumor of one or expectation of one rate cut in the US in 2026. We know that could, of course, be higher if the new chairman wants to do the bidding of the president and get rates down much lower. But for now, the consensus forecast is for one further cut. We know there'll likely be a further cut in the Bank of England today. This chart suggests the Bank of England would level out at a higher level than the US. This may have been the case when inflation seemed to be high. If there is a little bit more runway with inflation, the Bank of England could bring their rate into check. So not particularly concerned there about the Bank of England rate resting at a higher level than the Fed funds rate. I think those two will continue to converge. And the ECB at a much lower deposit rate, given how they have struggled with growth in the EU. They have significantly got inflation under control, and there was therefore a very convincing policy of rate cuts to deal with that. So more clarity, I'd say more certainty around rate cuts as we go into 2026. The expectation is at least that there will be some tailwind coming from that. When it comes to jobs and general economic vibes, jobs have not been great. We've had some gaps in the jobs numbers. We've had some revisions. We know that AI is definitely posing as a threat, not necessarily replacing the jobs at this point, but is competing for capital that would otherwise go to jobs. So we've heard a lot about the woes in the graduate job market and about some of the negative job numbers that are, I think, probably irritating President Trump at the moment. And he has been addressing that quite aggressively in many of his economic policy speeches. So, but overall, manufacturing work is seasonally adjusted. It has been ticking down, not too significant, but certainly not heading in the direction that he or anyone would like to see. Moving to equity markets then, although we will continue to touch upon economic vibes, we can see that US equities have been trading near record highs. And the really significant thing is the degree of investor bullishness. This can be indicated through flows, and fund managers are said to be most optimistic since 2021. Despite worries for tech valuations, they have been piling into equities at the expense of cash. This is somewhat surprising, given that cash still represents a somewhat meaningful return. It at least presents some positive real return at cash rates at 3.75 or more, and then inflation rates at 3%, as there's still a net real yield there that is meaningful, and certainly more meaningful than it had been during times of lower rates. So cash is not an explicit drag on portfolios, but perhaps there is a sense that this cash needs to be put to work. And I would say that the consensus across many of the 2026 outlooks that we've seen this year is that they are overwhelmingly bullish. And that would perhaps be a plus reason to drive more assets into equities. It could also be a factor, well, if not equities, where? And where else? With bond yields, we've spoken for many weeks about spreads being as tight as they are. This could be because yields themselves and the risk-free rate remained high, but bonds do not look like exceptional value today. As we look at where the yields are, they are perhaps not taking into account various credit risks, and therefore flows are running into equities. I will say, though, that this chart does not show the, as a wobble that we've seen in US equity markets just over the past few days. We've seen the S&P and the NASDAQ down over 1%. This is not significant in light of their year-to-date performance, which is comfortably in double digits. However, it is a sign that there is more and more punching of holes in the AI story, more, I say, skepticism regarding some of the build-outs. And this has been very well indicated in the scrutiny that we've seen around Meta. Just this week, there has been an analysis of what's called a turbulent bet on AI that Mark Zuckerberg has made. We spoke last week about his closure of the metaverse unit. Many job cuts came there, and his diversion of funds into AI. We can see from his acceleration in spending, there is a significant CapEx expenditure forecast in AI in 26 and beyond, which really sits at a multiple 3x what that level would have been in 2022. So there's always been a high level of CapEx by Meta, but it is now very much on a sharp increase, accelerating increase. When we look at how investors have treated this on again, off again AI bet, and I suppose some turbulence around that, which the headline suggests has led to rattling of investors and insiders, we can see that the Meta performance, despite it being in the Magnificent Seven, has actually been more of a round trip year to date. The blue line indicates how Meta had essentially performed quite well up to just the last few months. Now it is back to the level it was at the beginning of the year. And this is actually a bit of the story for all of the Magnificent Seven, in all of the focus on these stocks and just how extremely buoyant they have been and how they have really been the mainstay of the market runway. We can see that only Alphabet or Google, with its Gemini release and the major hype that accrued for the stock in the last few weeks, and Nvidia are significantly ahead of where they were at the beginning of the year. All of the others made back the ground that they lost during the run up to Liberation Day in April and the aftermath, but it was quite slow. In particular, we can see Tesla was very sluggish to get basically essentially to the point it was at before. That has continued to be weak in the aftermath, whereas other stocks such as Alphabet had a more subdued negative spell, and then they took off significantly. And every other stock is essentially round tripped. Even Apple is just barely above where it was at the beginning of the year, similar to Microsoft. So I'd say the story of the Magnificent Seven has not exactly been a smooth one, and we shouldn't think that this has been the entire story of the US stock market. It has certainly dominated it. And these two stocks, Alphabet and Nvidia, are now sizable in terms of market cap, over 5 trillion in the case of Nvidia, close to 4 trillion in the case of Alphabet. But when we think about that trajectory, it has not been a smooth run for all. And this is, we think, now being reflected in more rebalancing, more diversification as we look towards the end of the year. And that has been a very welcome development in markets as far as I'm concerned. Looking outside the US, there's been another sea change in how non-US investing has been perceived. We've seen quite a bit of, I say, changing of opinion. If we go back, the whole notion of one country being uninvestable within emerging markets really started with Russia, and that was in the run-up to the Ukraine invasion in February 22. We have a significant amount of sanctions, obviously, and selling out of Russia. And even before then, we know that emerging markets and other developed markets had been lagging the US. But in emerging markets case in particular, there was a 15-year period of lagging the US. This was accompanied with a strong US dollar. So we had the double whammy of the currency effect as well as the US lagging. When we look, however, now at China, China was the next country to get the uninvestable label after Russia. There was a suggestion for some time, particularly with trade wars, some saber rattling, some sense that there was not the same clarity regarding regulatory intervention. There was some sense that China would get the same treatment of Russia, that there would be a category of uninvestable, there would be sanctions, there would be a need to divest all Chinese holdings. It never came to that. And in fact, it would have been quite destabilizing to portfolios to pick apart the China exposure, which would have been significantly more than the Russian exposure. Well, now it seems that investors have had a short memory with respect to some of the regulatory uncertainty in China, which I would suggest has not gone away. And instead that has been supplanted with an awareness, and I think this is an important self-awareness of the limitations of some of the US and other developed market AI capabilities in comparison to China, which with DeepSeek just gave a sneak peek into some of their ability to copy and essentially to replicate and even exceed the functionality of the AI that was available, the models that were available in the US, and similarly that was open source. So it really gave scope for much more rapid adoption and replication. And we also know now that in EVs, there has been a similar dramatic development. This is an area where there are fewer regulatory strangleholds on the development of these tech. And even though in the US, it is also a fairly liberal economy when it comes to this permissive way, it's also the case that there would have been there would still be, in comparison to China, maybe more restrictions on development. So China has essentially been given free rein to develop this. Its economy and its stock market have been highly levered to the tech story. We've pointed this out before, that there may not be that much diversification from investing in China if it is essentially all levered to the same AI story that much of the US is levered to. But I thought this was an interesting quote, which suggests that what was once uninvestable then selectively interesting is now indispensable for some. As skeptics turn into believers, sidelined capital should re-enter China, helping to fuel the next phase of market ascent. That comes from a senior investment strategist for Asia at Amundi. And it is maybe when somebody's speaking their own book, but it is interesting to think that this now is considered indispensable, that we've really done a 180 turn in terms of Chinese sentiment. It's also interesting in terms of what's available to invest in China. We know that there was a pullback of investment personnel from China on the active side. So active stock picking may only be available through local providers or through a limited number of groups on the ground there. That would have to be done from outside the country. We tend to favor that less. It's generally better to be on the ground to have the insights. Chinese exposure could also be obtained through pure index exposure. But equally, when we look at some of the other funds, there's been definitely an increase in the release of EM ex-China funds, perhaps in response to the uninvestable moniker. And it would be interesting to see if these funds now start to unwind that ex-China positioning and embrace China as a main linchpin of the EM tech recovery. Getting back to mood music, a little bit of positive news out of the UK. We've seen a £12 billion fund allocated to research funding into AI, creative industries and life sciences. Not a king's ransom, not a huge amount, but it is a reflection of a recognition that the budget perhaps was anti-growth as a recent budget, and also that there is a need to actually put money into these ecosystems if we do want a thriving startup and entrepreneurial ecosystem as there is in place in the US. So a little bit of a positive news there out of the UK in that respect. It has been a busy few weeks for geopolitics, and I'd say we are in some uncharted waters now when it comes to both the perceived threat from Russia, particularly in Europe. We've talked before about the massive scaling up of European defense capabilities in response to really throwing down of the gauntlet by the US, and evidence that there would not be perhaps the automatic NATO support by the US. And equally, that there was a sense that the ambitions of Russia in terms of its expansion and its desire to provoke and be aggressive, particularly say with Poland, with the drone strikes there, was, or these drone incursions, that was at an unprecedented level in the modern era. So I'd say there is a heightened awareness at this point in Europe of the potential threat from Russia. It has not trickled down to become a kitchen table issue, I'd suggest, but it is definitely going to affect policy as well as political outcomes in the year ahead, a perceived readiness to deal with that threat. And equally, the expenditure on defense, which has been soaring in recent months and years in Europe, that is likely to continue, and also to bring that matter to the front of mind. Moving to a different zone of the world, looking at the Venezuelan situation with an order of a Venezuelan blockade, which has had a direct effect on oil prices. Some would suggest this is not out of the ordinary in terms of some of the strikes, on at least the interception of the tankers, but it is definitely, the rhetoric has been ramped up when it comes to Venezuela, discussion of oil strikes, etc. And we are potentially in a situation of having to look closely at whether that will likely accelerate. I would suggest it would be slightly more contained when it comes to oil prices too. The impact on oil will be contained, but this will be yet another factor that floods the zone with uncertainty and creates, I'd say, a less buoyant outlook for 2026 than we previously would have had. To end on Bitcoin, we know that this has been quite a trajectory that Bitcoin has shown over the past year. It is on track for an annual loss, only its fourth annual loss since it first started trading in 2014. The annual loss we're forecasting is close to 8%, so clearly nowhere near as dire as the 74% loss in 2018 or the 64% loss in 2022. And this all has to be looked at in the context of the staggering increase that Bitcoin has shown when it has rallied, rising over 1,000% in 2017, 300% in 2020, 120% in 2024. It's interesting that these wild swings are coming down somewhat, and particularly on the downside, whether that's due to a diversification of Bitcoin and the fact that it has been now used in ETFs, more broadly held, and equally, there's still a very fundamental, strong tailwind there with the regulatory backing that it has. But I would say that this just indicates just the level of volatility that we can expect in Bitcoin, That 7.8% negative number does not reflect the volatility that we've seen throughout the year, and the fact that it does seem to be really a bellwether for risk appetite and for movements in other risk assets. So more to come when it comes to Bitcoin's impact on risk assets and on our outlook. And we know that digital assets will continue to be at the fore in 2026, but this is a sobering recognition that it hasn't been a fantastic year for Bitcoin, even though it's been a fantastic year for traditional diversifiers such as gold, silver, and that may be due to completely different factors, as we've discussed. Concern around currency debasement, concern around the fiscal budget situation, but it is notable that Bitcoin has not been the panacea that we'd hoped. So that is the end of prepared remarks for this week. I wanted to quickly reflect on where we sit in portfolios and what this means for our portfolio going forward. So if we go through the different asset classes, equities will have had a great year, despite the current, I'd say, little bit of turbulence in November, and I suppose a little bit of humbug in the last week. Equities will have exceeded expectations. They have been generally backed with strong fundamentals. We spoke about the earnings picture last week, showed how strong across the board, almost every sector, over 50% of companies there in every sector. And in some cases, 90% of companies in healthcare had exceeded earnings expectations. So earnings have been strong. Some of that is due to cost cutting, which will have repercussions down the line. But we also see a broadening of markets as some of the sheen comes off the big tech stocks. We see that investors have been eager to get into different sectors, to look beyond the large cap into the small and mid cap, and equally to look beyond the US. And China, as we know, is the new shiny object in that respect. But there is definitely a sign of desire, a willingness to diversify. Equities will still remain the main engine for growth in a portfolio. We know that bonds with the spreads they're at today will be perhaps a decent hedge, but are unlikely to be a strong source of return. So investors that are focused on growth, focused on outperforming inflation, will always need to have a high allocation to equities. Despite some of the reticence around the AI story just in the past few weeks, and perhaps a desire to be more skeptical, we do know that the infrastructure, the picks and shovels, they still need to be in place. And the expenditure on data centers, on infrastructure funds, real asset funds that get exposure to the energy production story, that we see as being a particularly strong underpinning of any portfolio going into 2026. Inflation has not gone away. We still need to think about inflation resilience and having that spread beyond pure equities into the other inflation participating assets, such as real assets, is critical. We also reflect on the fact that other private markets have seen tightening and perhaps a flushing out of some less robust players. That has definitely occurred in the case of private credit. There's been more competition, which is naturally leading to lower returns, but also perhaps a dominance of some of the more established players. Private equity, venture capital also continue to have a question mark over their distribution pattern, over their performance in line with previous expectations. And I'd say there will continue in 2026 to be a scrutiny of that. When it comes to the geopolitical forces, markets seem to be somewhat, I'd say, resilient against geopolitical shocks, although we do now know that their tolerance level for unorthodox trade policy and geopolitical or foreign policy is quite a bit higher now that they've weathered the storm of the Liberation Day shocks and their aftermath. So I would expect less in terms of shocks for that going forward, but we know we're expecting lower rates. If that were not to occur, that would be a negative surprise. The consumer is holding it together. If that were not to occur on a broader scale, and we were to see broad-based fall off in spending, say, after the holiday, that would be a negative surprise. And overall, this focus on affordability, we know, is the linchpin of consumer health and sentiment, and we can see a continuation of that into 2026 and beyond. So that is the end of our podcast for today. I wish all of our listeners a wonderful Christmas and holiday season and look forward to seeing you on December 26th. Thank you, everyone.